Good morning. Martin, it's fantastic to be here. I'm glad you made it.
Thank you. We had a little car mix-up, so I had to sprint up the escalator. So I'm sweating not because I'm nervous, but because I'm a little out of wind. But I'm happy to be here for sure.
It's great you're ready. So I was preparing this, and I talked to friends and then people who invest, and they said, "Why you talk to Martin Taylor? He's a rock star." And I think it's pretty cool. I haven't interviewed a rock star in a very long time. So for those who don't know Martin, he's the co-head of the foundation fund at Vista Equity Partners. He sits on the firm executive committee. You sit on the firm private equity management committee. You sit on the board of a large number of the companies you've invested in. And Martin's not just an investor, right? You basically spent 15 years at Microsoft before joining in actual executive roles. So he basically came in with an operator and tech operator mindset into this business. The other thing about Martin is he's involved beyond investment. So at the Milken Institute, I think you're involved in inclusion, equity in the asset management industry. So we're talking to a rock star. So let me start with a couple questions about what you do, right? So you focus on the enterprise software market, right? And today sounds like a pretty obvious choice, but you made this choice 20 years ago. Could you lead us a little bit through why and how you actually made that decision, and why you didn't invest in things that were probably more fashionable at the time, like B2C, internet, social networks, etc.?
Yeah, no, and first of all, thank you very much for the kind introduction, and thank you all for being here today. We started at Vista 23 years ago with the fundamental understanding that enterprise software truly will be transformative in every single aspect and facet of our lives. And if you think about enterprise software specifically as an asset class, it's such an attractive place for financial investors. If you think about the dynamics of these types of businesses, they are very mission critical. People have to use the solutions that we invest in every single day. I like to use the phrase with our portfolio companies, we love businesses where people have to turn it on every day before they start their job, and it's the last thing they turn off before they leave to go home. Some of the characteristics of the enterprise software market, we've got in our portfolio company, about a 640% return on investment. If you take a look at what people invest in versus the value that they get out of using our solutions, that's 3.5 times more than many other value creation and RO type initiatives that we see happening. It's also a solution that has very high customer retention. Many of you in this room are probably users of enterprise software, and you'd probably admit that once you learn how to use a system, the last thing you want to do is get that email from IT saying we're upgrading it and you now need to learn a different way to do it. And so when you have something that's very mission critical, that has incredibly high return on investment, that has high retention characteristics, and then the way that we also look at it is we have an opportunity to create a recurring revenue stream. Many of our businesses begin the year with 85% of their revenue already accounted for going into the year. And so we were very attracted to the space 20 plus years ago because of those fundamentals. And amazingly, they've stayed true. If nothing else, they've just increased. You see the proliferation of enterprise software in every aspect of life. And so we think that this is an asset class that will continue to grow and scale. And we feel great that we were in some ways pioneers in investing in enterprise software, to your point, back in the early 2000s when Y2K had just ended and B2C was kind of a thing that people were looking into.
One of the things about B2B is that it's less capital intensive than B2C, right? Customer acquisition is cheaper. So do you think that the current rate environment is making it even more attractive on a relative basis?
In some ways, when you think about the current rate environment and how we think about it, we've never really looked at using significant leverage to get a return profile, specifically in the foundation fund or the mid-market space, where you really got to grow into your return and how you get there. That being said, because we can run our companies, if done right, at north of 90% gross margins. And many enterprise software companies, especially now with the conversations, are profitable businesses very early on. It does allow us to not have to rely on debt and financing to invest and grow these businesses.
Interesting. So let's step back for a second. There's been a difficult time in the market over the past 18, 24 months, a significant slowdown. And there was a disruption in valuation. Today it's settling down, but there's still a difference or a disconnect between public and private valuation. Do you want to comment on this a little bit?
Yeah, there's a saying a little bit in our space that private market valuations go up on the elevator as public markets go up, and they come down on the stairs as they come down. And so we definitely have not seen back when, I'd probably say early 22, the latter part of 21, probably middle part of 22, when you saw the large tech platforms begin to decrease in value on a public market standpoint, you did not quite see private market software valuations come down quite as dramatically. Now, again, part of that's just a normal disconnect that happens between those markets. But for an investor on our side, what that meant for us was opportunity. And so you saw our flagship fund do quite a few take privates when we saw that there was a dislocation in the inherent value that we saw in these businesses versus what the public markets were giving those businesses. That being said, we also think, and we begin to see now, that the valuations of these businesses are a little bit more segmented than just saying broadly technology. As an example, you think back in 21 when things were arguably at an all-time high in different areas, marketing tech solutions were valued incredibly high. You had the CMO, the chief marketing officer, with an access to a trove of data that they now had the ability to mine and drive marketing campaigns to their customers. And so you saw a really big spike in valuations. As macro uncertainty hit, through all the things that we all know pretty well, you began to see a contraction in marketing budgets. And so, to no surprise, the valuations for those technology companies that provided solutions to the CMO's office also began to come down. But conversely, you saw situations or solutions for the office of the CFO begun to increase, because now the CFO cares about productivity, cares about profitability. And so that's quite honestly why IBM acquired Apptio, one of our portfolio companies, just recently, as they focus on total business spend and total spend management. So we look at volatility and we look at valuations a bit more sector specific than broadly saying technology.
Interesting. So a lot of the commentary in the press focuses on the very, very large companies, right? You focus on the mid-market. What do you look for in a great investment? What is it that makes a fantastic company to invest in for you?
Yeah, no, that's a great question, and we've got 23 years of history of doing it, and so I love to talk a bit. So maybe start at the high level. At Vista overall, our platform, be it our mid-cap, large cap, be it our credit strategy, we all focus on a few similar characteristics, and that is enterprise solution, mission critical, high recurring revenue, opportunity to drive up customer retention and have a very sticky solution. And that's universal across our platform. And we've probably looked at about 9,000 businesses in our history, about 2,000 businesses that we've looked at since the pandemic itself. So we have a very great opportunity to almost look at any sizable enterprise software company that's going to come to market. In the foundation fund, specifically in the mid-market strategy, and these are enterprise values, call it from 250 million up to about $1.25 billion. In that space, we've identified three types of companies that really make for a quote-unquote great investment, to your question. One is what I might call a category consolidator. It's a business that either through a roll-up strategy or just through growth overall, they dominate their sector. They are the quote-unquote IBM, for those of us that are old, that know you're about as old as me based on your hair, I can tell. I don't have any. But IBM was you never got fired for buying IBM back in our younger days. And so in a very similar fashion, we have a company, Granicus, that in the U.S. that sells to state and local governments. They are the de facto standard for that solution. And so consolidators are great solutions for our mid-market strategy. The second area is what I would call digital disruptors. These are companies where there's an entrenched competitor that's probably large, they're legacy provider, they've not made the innovation and newer solutions, and we can acquire companies that can then take share and grow in that space. And then probably the third area, I'd say, you've got your consolidators, you've got your digital innovators, and then you've got people that actually create a category. There's a solution here actually in the APAC region called StarRes. They provide, it's based in Melbourne, Australia. They provide solutions for student housing. And so if anyone has a student or a sister or brother or cousin that has gone to university and need to get housing, more often than not, StarRes was a solution that managed that process. They pretty much created the category. And so we love those three types of businesses. We find that we can invest in those businesses and help them scale and grow over time and have a great return for our investors.
Interesting. So you now know that Martin and I compete on haircuts. So let's talk about value creation. Part of the past 15 years have been great. Multiple expansion, a bit of leverage. A lot of firms have actually made a lot of money just by doing that, right? That's done. Now you work with portfolio companies to create value. Can you explain to us how you work with them? I mean, in this environment, I guess part of the game is mitigating risks. And the other part is to continue to build and continue to expand, right? How do you work with companies?
Yeah, you know, that's one of the, I'd say, guiding fundamental principles as we created our platform. So when I joined Vista, as you mentioned, back in 2006, you know, I'd spent the first 14 years of my career at Microsoft. We made a fundamental decision that we're going to create value for our shareholders by actually taking a platform of best practices, partnering with our executives and our portfolios, and truly creating value. We're not going to underwrite to multiple expansion. We're not going to look at financial engineering. We're actually going to do the heavy lifting, partnering with our portfolio companies. Now, we're somewhat uniquely positioned to do that because we just own enterprise software businesses, as I said earlier. And there are a lot of repeatable practices that you can do when you own the same types of companies. And so we, over the time, we have about 105 white papers and best practices that we bring to our portfolio companies. We've got 115 subject matter experts. And so when we do an acquisition, we partner with management saying, hey, here's a list of things that we have done over the last 20 plus years that have created value for businesses just like yours. How do we partner together to create value for you as well? And I would say that in the current market environment, it's really proven out that, you know, the work that we did for the last 20 years have put us in a position to really partner uniquely and differentiated with our portfolio companies. And we really saw this play out when the pandemic hit. We didn't have to scramble that much. We had a rhythm and an interaction level with our portfolio companies where we could make the proper adjustments as, you know, we hit that wave, so to speak.
So given your comment about our ages, you'll relate to this. I don't know, it was like late 80s, early 90s, I was trying to teach a VAX computer how to read. And that was a bit painful. It took a long time. It took minutes to recognize a few letters. It was right. Painful. Now AI has gone a really, really long way, and it's now on everybody's lips, right? Now, surely in enterprise software, this is an area where you must be pushing companies to transform their products and adopt some of that technology. Can you talk a little bit about this?
You know, we tell our companies that Gen AI, it's just a fad, don't worry about it. No, this is an area where we do actually look at this as the next wave of transformative technologies, very similar, akin to how cloud computing completely changed everything from on-prem to cloud, and the work, as you mentioned, that we did in the late 80s and early 90s, you know, what we had to work within versus the environment we're in today and how cloud computing has changed that. Gen AI, for sure, is something that will be transformative to all of our portfolio companies and, quite honestly, every industry and every business. The approach that we've taken is threefold, I'd say. First of all, as investors, we're working with our teams to say, hey, how do we look at Gen AI to help our investment teams be better? How can we do diligence more effectively? How can we learn a space that we might not know better, faster? How can we have our junior teams understand nuances about segments, about competitive dynamics in different industries that might take, you know, weeks to actually go figure out that we can now do in hours and days? And so so internally, we're looking at every single aspect of our process and how does Gen AI help us internally be more productive? And then you translate that to our portfolio companies, and it's really in three different areas, I say. First of all, as they're building products, how do they look at Gen AI and large learning models as ways to help them build better products? And how do they think about their product portfolio and what they can do within that portfolio to enhance a product and enhance an offering based on generative AI? The same work that we're doing internally to make Vista more productive, our portfolio companies are doing the same things to become more productive. We have a company that has about 20 copywriters today scanning the internet, putting information together that their customers might find useful around safety and regulatory awareness. We can now reduce that team to 5 people because they're using Gen AI to basically build those copies and build that material. So a lot of internal productivity gains that our portfolio companies see. And then the third area is really from a risk perspective. And so as they're looking at, are their customers doing things differently? Do their customers have access to large learning models that they can then tap into that then make maybe our products less relevant or make us have to change how we think? So we've developed a risk rubric for all of our portfolio companies to understand every single one of your product, what's your risk score based on Gen AI that exists in the marketplace. And we take that same approach to looking at deals. So now that we're doing diligence, we have one other sector to look at, which is how is Gen AI going to make this company and or their products at risk based on what's happening in the marketplace. And then lastly, because of our size and scale, we have a unique opportunity to partner with Microsoft, with AWS, with GCP as our platform partners to incorporate AI technologies into our portfolio companies. And so we just recently had a hackathon in Bangalore last week. We had 30 portfolio companies spending 3 days, and most didn't even sleep. You know, they were on a bunch of Diet Cokes and pizzas and spent 3 days building and designing solutions that we might bring to market across those 27 portfolio companies with the partnership of AWS and Microsoft at that hackathon.
Interesting. So let's step back again for a second. Let's talk about pipeline. Are companies transacting at the current valuations, or are the best companies waiting? Are they thinking about different capital structure to avoid dilution? How do you see the next 12, 18 months?
No, it's a very fair question. I'd say, you know, had we had this conversation in February, March, I would say everybody's on the fence. You know, you have some C-plus assets maybe coming to market, but we didn't see a lot of activity. We're now seeing assets come to market. You know, I'd say our pipeline, at least from a calendar year perspective, is probably as large as it's been this year in terms of activity and deal flow. We just signed a deal under LOI that will close in a couple weeks. It'll be our first deal in our mid-market strategy in about 12 months. And there's about 4 deals behind that that we're looking at. And so you're now seeing deals come to market, partly because you have LPs that need to get a return. You have things getting long in a portfolio cycle. Then the other area is venture capital and growth equity. They're not making some of the investments. They're not really doing many down rounds right now. And so you have some of these mid-market and smaller companies without a real funding source. So the only option is to probably be acquired, you know, become part of a larger platform. And so it's definitely not the frantic pace of 2021, but we're definitely seeing things loosen up that should bode for a pretty good Q4 and, more importantly, a pretty solid Q1 and early Q2 based on our pipeline activity.
Okay. So the counter is blinking 0.
Well, I never worry about that.
And any final thoughts for people? I mean, we're in Asia, and any comments about what's going on here or anything else you'd like to share before we part?
I do worry when she walks up, though. Okay, we'll wrap up, I promise.
She looks very threatening.
She looks very serious. But no, this is a great market for us. We continue to grow and expand here. We've got about 57 portfolio companies that generate over $500 million in 2022 just from this region alone. I mentioned, you know, a recent acquisition based in Melbourne, Australia. We've got about 18,000 portfolio company employees spread out across the region. And we're now getting to the point where we're looking actually to do some larger acquisitions here as we can find some broader opportunities. And so this is probably the highest growth region for us on many fronts. And so we're looking forward to continuing to do things here in the region.
Great. Thanks, Martin.
Well, thank you so much. Nice to meet you, and thanks for the time.